We're 40 minutes into the trading day and tech outperforming once again. This on the back of stronger than expected earnings results from Meta. You've got that stock up nearly 10% so far today. Solid ad revenue growth quieting some fears about increased CapEx spending on AI. Here's what CEO Mark Zuckerberg had to say about the company's spending plans going forward.
At this point, I'd rather risk building capacity before it is needed rather than too late, given the long lead times for spinning up new infra projects.
For more on that, we want to bring in Dan Morgan. He's Synovus Vice President and Senior Portfolio Manager. And we also want to mention that Synovus owns shares of Meta. So Dan, you're the perfect person to talk to about this. Lots of questions that we have been getting here from strategists, from investors, and even just taking a look at the street's reaction to these earnings prints so far is whether or not some of these larger tech names are spending too much on AI at this point. What do you think?
Well, it's kind of interesting because, we know during the second quarter call, Facebook or Meta came out, did say they were going to inch up their CapEx spending, which would be dedicated towards AI as high as $40 billion for the year. Just about all of the big mega tech companies are spending a lot of money on AI. What's kind of interesting, Sean and Madison, is that it seems that Meta came out and their core business was doing very well, right? Their efforts that they've had in terms of AI ad targeting seem to really pay off. Ad revenues were up 22%. Compare that to Alphabet, where ad revenues were only up 13% on their YouTube franchise and 11% on their larger frame. So it seems like if companies are able to spend a lot of money on AI and their core businesses are doing very well, they're rewarded. But if they're spending a lot on AI like Alphabet and they come up a little bit short on their core ad business, then all of a sudden the stock sells off. So it's kind of interesting.
Well, it's interesting, particularly given the varied reactions that we've seen from big tech firms reporting an increase in CapEx on AI. I'm curious from your perspective, what it is about Meta that is allowing them to underspend versus consensus. Their free cash flow continues to outpace CapEx. What is it about the management of the balance sheet at that firm specifically that's allowing for that to continue?
I think it's their past history. They put a lot of money into the metaverse, right? We kept hearing about that from Mark Zuckerberg. That was the new thing, right? 2 years ago, everybody was really excited about it. This is before AI really took off. And then they kind of got away from that and dedicated those funds over towards AI. And I think that's really helped them compared to other companies that are just kind of, in the last year and a half, 2 years since Microsoft, got involved with ChatGPT. They've all dedicated their funds towards, or CapEx towards AI. So I think it's a fact that we're seeing a better return on investment versus metaverse, which is what Facebook, Meta was spending on before via AI. And I think that's why they're getting rewarded.
Yeah, it was interesting to see them sort of point out the examples on the call for how that CapEx is helping them versus maybe some of the other big tech names so far. Having said that, I also want to ask you about what we're hearing from CEOs about opportunity in AI. We've heard this kind of hint that perhaps there's more opportunity in AI than there was in, the internet boom and then maybe even in the cloud space. Would you agree with that?
Well, Madison, Sean, I hate to pop the balloon, but I've been following technology stocks since like 1990. So I went through the huge waves that occurred in the 90s, which was the build out of the internet, right? Everyone getting a mobile phone off a landline, the movement from a mainframe Unix to a client server environment. Those were huge mega waves that just drove tremendous amount of spending, especially building out an internet presence for every company in the US. And that's what really drove. Then, of course, you had the year 2000 glitch where everybody was trying to correct in their code. So you had like 4 major trends during the 1990s that really propelled technology. And, this most recent one in regards to AI, Madison, Shauna, the jury is kind of still out, right? Because we're spending so much money on it. We're really not seeing a huge amount of return up to this point from these hyperscalers. So I don't know if AI is at the same level as, going from, let's say 10 million mobile phones to 500 million mobile phones over a 10-year period worldwide. So I think the jury's still out. I don't know if AI is quite as big as some of those mega trends that we saw in the 1990s.
Dan, I'm curious, and what do you think that then tells us about the likely performance we're going to see from some of these tech names? Even when you compare, and I know it's just a very small data point here, but even when you compare the outperformance of the chip makers yesterday versus what we have seen in reaction to some of these larger CapEx AI spending plans from the hyperscalers, do you think we're going to see a widening of that gap for names like NVIDIA and AMD versus names like Microsoft and Alphabet?
Well, it's interesting because you mentioned AMD and NVIDIA. Like, if you think about the gold rush, would you rather be the person who's digging the gold, or would you rather be the person that's selling the equipment to dig for gold? And NVIDIA and AMD sell the chips that allow companies like Microsoft, and we're going to get AWS with Amazon later today, Meta, they all buy chips from NVIDIA and some buy from AMD. So, it's interesting, Madison, Shauna, because we've seen these huge multiple stretches, right? Not so much with Meta, but with Microsoft. Apple's trading, I think right now, like 42 times earnings, 39 times fiscal year 2024. So you've had huge multiple expansions on a lot of these huge tech names that everybody's been involved with for the last 10 years. And now we're seeing a little bit of correction back again. And yet we saw AMD report numbers a couple days ago. They blew out on their data center business, and all of a sudden AMD and NVIDIA are taking back off again, and the multiples are off the chart. So there's a lot of recalibrating going on right now based on these earnings reports as we continue to get evidence that AI is actually impacting numbers.
So Dan, then what do you think that tells us about what we're likely going to hear from Amazon tonight? Are they going to be, do you think, under a bit of pressure or similar maybe sort of reaction to what we saw from Alphabet, and some maybe questions surrounding Microsoft's CapEx spending too?
Yeah, so I think everyone's going to focus on AWS growth, right? Because we saw GCP for Alphabet, that came in, I think, around 28.5% growth. We had Azure come in a little bit below at 29% growth. Street was looking for 30 to 32. We have to bear in mind that AWS, which is their data center service business, was growing around 12, 13%. Now, it recently accelerated in the first quarter to kind of like a 17 to 18% growth rate. So anything north of that, Shauna and Madison, that we can see out of Amazon with AWS, where they're showing some sort of direct result related to AI, where we did see, let's say, with to a slight extent with Azure, that would be construed as a positive. Now, if they go back and show deaccelerating growth in AWS and go back to their baseline before, which is around 12, 13% growth, that's going to be a problem. So I think all eyes on Amazon and all eyes on AWS.
All right, Dan Morgan, always great to get your insights. Synovus Vice President and Senior Portfolio Manager. Thanks so much.